Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets. New York coffee. There has been a pause here, maybe even more than just a pause, since late June, from the definitive break lower from the second, flatter but also lopsided and larger January to mid-June diamond pattern is the one that is highlighted in bright red on my daily chart. We now have overhead the following resistances: 2016 high at 179.55, the influential neckline currently 177.35 of the January 2020 to April 2021 reverse head and shoulders bottom, and the congestion, quite a lot of congestion in fact, between 174 to 174.5, containing the August 2021 low at 174.5 and the 50% Fibonacci line of the May 2019 to February 22 move at 174. We also have nearby the declining short-medium moving average currently at 169.45, the medium moving average currently 176.15, and the long moving average currently 172.95. Until these moving averages and resistances, we have a fairly free overhead, or at least we did have until this week, area. For this to become clear, we have to take a step back and see how the drop in late June through to mid-July, all the way down through the 2017 high at 159.30, finally reached the primary target in the 156.35 zone with the lopsided diamond pattern before stabilizing. Now, we still have the secondary harder to reach target X1 down in the 141.80 zone, though that is looking increasingly distant at this moment. Okay, so the drop down saw the formation of another pattern, a small descending scallop pattern, a pattern I've been discussing here for a few weeks now. This is where the clarity of vision comes in for the recent action. You see, the descending scallop pattern, the one that looks like a ski jump, has also helped construct over the last 4 weeks a small bull channel, currently 159.65 to 168.55. This is where we are now, though it does throw up some intriguing possibilities for future actions, such as a possible rounded bottom or alternatively a bearish half hesitation. However, I'm getting way ahead of myself. For the moment, the small bull channel is the pattern of our times, though it would not surprise me to see this morph into something else in the future. The key will be to see how and where the descending scallop pattern finishes its construction. London coffee. The changeover gap, originally 24.93 to 26.17, saw the market push down through the core of July's support, the important short-medium moving average currently at 25.91, and turn that into clear resistance. Prices dropped below support at 25.18, 24.68, and even the rising medium moving average currently 24.73. But this was where they started to stabilize, just above support at 24.11, which was also target X, the primary target for a pattern I mentioned 2 weeks ago, a bump and run reversal top. We have come awfully close to reaching target X, and I am still watching carefully in case prices do try down to that. However, we also have the much harder potential secondary target X1 for this pattern below, around the highs of late February and early March, at about the lesser Fibonacci line at 22.03. I'm currently doubtful as to whether we'll see this secondary target. This brings me to a controversial point, and one I apply that others might not. You see, I use continuous charts in my technical analysis, and there are heaps of arguments on what you should do or not do when you have changeover. I am consistent in what I do. I ignore the change, and I apply it as part of the market's actions, even when it might seemingly not be accurate. This leads to the controversial action I have on my daily chart 2 weeks ago of a weekly key reversal down made up from 2 separate actions. Many indeed, might not agree, but that is how I deal with this situation. Furthermore, the situation also lent itself last week to being a possible bear flag. That is the late June to date action. As I said last week, and I quote, there is a huge question mark over this idea, so please treat it accordingly. For your information, I haven't marked any target below, but it would be in a 2400 zone if I had. End of quote. This week has shown no inclination to follow through with this weekly key reversal down idea, so for the moment I'll place it on the back burner along with the bear flag idea, possibly with the idea of retiring it next week if things stay the same. There's one other new feature I'd like to look at and discuss. I've drawn a mid-June to date descending wedge pattern, currently 2405 to 2608. It's not highlighted at this time. You can see it, but it's not highlighted. I have reasonable confidence in the upper trend line as it was made prior to the changeover, though the lower trend line is made up post changeover. I would need to see further action around these trend lines to verify this pattern to my mind, but for now it will do. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.